If you think your money is safe in the bank right now, you are making a dangerous assumption, and most people will not realize why until it shows up in their savings account, their rent, and their investments. Stay with me until the end, because I am going to give you a clear checklist of what to watch and what to do next, and I will point you to the institutions and signals that actually matter. And before we start, like this video and subscribe, so I can keep explaining the financial pressures most Americans are coping with, but rarely get explained honestly. The Federal Reserve just made a move that looks small on the surface and massive underneath. In December 2025, the Fed cut interest rates by 25 basis points, bringing the federal funds rate down from 3.75% to 3.5%. To most people, that sounds boring, technical, easy to ignore. And that is exactly why it matters so much. Here's what you need to understand, and stay with me, because this only clicks once you see the sequence. This was not a calm, confident decision. Several Fed officials dissented. That is rare. And dissent at the Fed is not noise. It is a signal. It tells you the committee is not aligned, not comfortable, and not moving from a position of strength. It is acting under pressure. When central bankers disagree publicly, it means the trade-offs are ugly, and every option carries risk. Now here is what most people miss. Rate cuts usually happen when inflation is crushed, or when the economy is clearly breaking. Neither of those conditions fully existed. Inflation was not dead. Growth was not collapsing. So why cut? Because something else is tightening behind the scenes. The Fed is not just looking at prices and jobs. It is looking at the plumbing, government debt, refinancing schedules, liquidity stress, market fragility. And when those pressures rise, rate cuts stop being about stimulus and start being about stability, not growth, survival. This is why the dissent matters. Some officials know that cutting rates now risks inflating asset bubbles. Others know that not cutting risks something worse. When the Fed chooses the lesser evil, it is not optimism. It is damage control. And here is the part that should keep you watching. This was not framed as a one-time adjustment. It was the third cut in a year, and it came with guidance pointing toward more. That tells markets the direction of travel, and markets react to direction, not excuses. So if you are a saver, an investor, or someone just trying to stay ahead, this is not background noise. This is the opening move in a longer sequence. And in a moment, I am going to explain exactly what that sequence usually leads to, and what you should be watching next before it shows up in your wallet. This was also not a one-off. It was the third rate cut in a single year, and it came with forward guidance that clearly points to more cuts ahead. The Fed's own dot plot quietly flipped from hold to ease. Markets noticed immediately. Bond yields reacted. Risk assets reacted. Because markets understand what this really signals. This is the same Federal Reserve that spent 2 years telling you inflation was the biggest threat to stability. The same Fed that promised rates would stay higher for longer. The same Fed whose mandate is price stability. So the obvious question is, why now? And more importantly, what does this mean for your money? This decision has very little to do with inflation, and this is where most people get misled. The Federal Reserve is fully aware of what cutting rates does next. They know lower rates push asset prices higher. They know cheaper money fuels speculation. They know it widens the gap between people who own assets and people who live on wages. None of this is accidental, and yet they are doing it anyway. So the obvious question is why? The answer is fiscal dominance. And once you understand this, the entire move makes sense. Fiscal dominance is what happens when government debt becomes so large that monetary policy stops being primarily about managing inflation or employment and starts being about keeping the financial system functioning under the weight of interest payments. At that point, central banks lose flexibility. They are no longer choosing the best option. They are choosing the least destructive one. Let me make this concrete. the United States has accumulated tens of trillions of dollars in debt. A large portion of that debt was issued when interest rates were near zero. As that debt matures, it has to be refinanced. There is no alternative. If rates stay high during refinancing, interest costs explode. Those costs do not just grow linearly, they compound. Every small increase in rates translates into hundreds of billions of dollars in additional annual expense. Pause here for a moment, because this is the turning point. When interest payments rise faster than tax revenue, the government has only three options: cut spending aggressively, raise taxes dramatically, or allow monetary conditions to ease, so the debt can be serviced without immediate collapse. Historically, the first two are politically toxic. The third is survivable, at least in the short term. That is why rate cuts happen even when inflation is not fully defeated. This is not about helping consumers. It is about preventing a debt spiral. The Fed is not choosing growth over inflation. It is choosing stability over crisis. And here is the consequence you need to internalize. Under fiscal dominance, asset inflation becomes the release valve. Prices rise not because the economy is healthy, but because money has to flow somewhere. If you understand that, you stop being confused by Fed actions. And in the next part, I will explain exactly how this dynamic reshapes savings, investing, and opportunity for everyday Americans, long before it shows up in the headlines. Beginning in 2026, the United States runs directly into a massive wall of debt that cannot be avoided, delayed, or negotiated away. This is not a forecast. It is a schedule. Trillions of dollars of U.S. government debt were issued years ago when interest rates were near zero. Those bonds are maturing. And when they mature, they must be refinanced. There is no option to skip it. There is no option to wait for a better time. Here is what most people misunderstand. Refinancing does not happen at yesterday's rates. It happens at today's rates. Even after recent cuts, today's rates are dramatically higher than the rates at which much of this debt was originally issued. That means the cost of servicing the same pile of debt jumps sharply, even if the total debt number does not grow. And that jump is already visible in the federal budget. Interest on the national debt has quietly become one of the largest line items the government pays every year. Larger than national defense. Larger than Medicaid. That should stop you cold. Because interest does not build roads. It does not fund research. It does not improve productivity. It is a pure transfer cost for past decisions. This is where the pressure becomes unavoidable. As interest payments rise, they crowd out everything else. Every dollar spent servicing debt is a dollar that cannot go to infrastructure, social programs, or tax relief. And when interest costs rise faster than tax revenue, deficits widen automatically, not because of new spending, because of math. This is why policy options narrow so quickly. Cutting spending aggressively triggers political backlash. Raising taxes sharply risks slowing growth. Allowing rates to stay high risks turning refinancing into a debt spiral. So policymakers look for the least explosive path. And this is the key insight to hold on to. Rate cuts in this environment are not about stimulus. They are about survival. They are about keeping refinancing costs manageable long enough to avoid a fiscal shock. Once you see that, the Fed's behavior stops looking confusing and starts looking constrained. And in the next part, I will show you why this debt wall forces choices that quietly reshape inflation, asset prices, and opportunity for everyday Americans long before most people realize the game has changed. That should hit like a sledgehammer. Debt does not disappear. It stacks. And when you cannot pay it down, you roll it over. If rates stay high, interest costs explode. If interest costs explode, deficits spiral. And when deficits spiral, the only remaining option is monetary expansion, printing, liquidity, inflation. The Fed will never say that out loud, but this rate cut is the signal. Even while the Fed claims it is shrinking its balance sheet, liquidity is already easing through other channels. Rate cuts reduce borrowing costs. Treasury refinancing injects money into the system. Reserve management purchases quietly expand balance sheet exposure again. On paper, quantitative tightening exists. In reality, financial conditions are loosening. Here is the analogy. This is not a healthy engine cooling down. This is an overheated engine being revved harder, because shutting it off would cause immediate failure. By cutting rates, the Fed may slow headline CPI temporarily, but it will spike asset prices, stocks, housing, commodities, Bitcoin, anything that protects against currency debasement, and that creates a second inflation that most people never escape. This is where the U.S. citizen example matters. Roughly 90% of Americans live paycheck to paycheck or rely on saving to get ahead. When inflation quietly erodes purchasing power and asset prices explode higher, there is nowhere to hide. Cash loses value. Homes become unaffordable. Stocks feel expensive, and wages lag. For people who already own assets, rising prices feel like wealth. For everyone else, it feels like falling behind. And here is the dangerous part. Asset prices are now detached from business fundamentals. That is how bubbles form. And when bubbles correct, they do not correct gently. They correct violently, especially when debt is involved. We have seen this movie before. The dot-com crash, the financial crisis. Every time, cheap money pushed people further out on the risk curve. More leverage, more speculation. And when conditions changed, wealth transferred from the over-levered to the liquid. Now here is the part most people miss. This situation is not self-correcting. Without a balanced federal budget or a debt reset, inflationary pressure compounds. Politics prevents discipline. Elections reward short-term comfort, not long-term stability. And that is why this rate cut was unavoidable. Not because it is smart, because it is survivable. Cutting rates buys time. It allows debt to be refinanced without immediate cardiac arrest. But it does so by fueling the everything bubble instead of dealing with the underlying problem. That is why markets feel manic. Smart money knows exactly how this ends. Some are betting on continued asset inflation. Others are positioning for a crash. Many are doing both with leverage because money is cheap, and that volatility is the signal. Now do not panic. This is not a call to freak out. Systems like this exist all over the world and always have. The key is positioning. And this is where I deliver what I promised. Here is the checklist for living inside a debt-dominated, inflation-prone system. And this is not theory. This is how people who stay solvent across cycles actually behave. First, understand that cash is not neutral anymore. Cash feels safe because the number does not move. But in an inflationary system, that stability is an illusion. Every dollar sitting idle quietly loses purchasing power over time. That does not mean cash is useless. You still need liquidity for bills, emergencies, and flexibility. But excess cash is exposure. Saving alone will not get you ahead in a system where money is being diluted to manage debt. The solution is intentional cash. Keep what you need for safety. Put the rest to work deliberately. Second, you need assets. Not speculation, not gambling. Assets that either produce income or are scarce by nature. Productive businesses, real estate with durable demand, long-term equity exposure, scarce stores of value. The key is consistency, not timing. Dollar cost averaging matters because almost no one gets entry points right. This is not about being clever. It is about staying invested through volatility, so inflation does not eat you alive while you wait for perfect conditions. Third, diversify across economic forces, not just ticker symbols. Owning 10 stocks is not diversification if they all respond the same way to inflation, recession, or liquidity shifts. You want exposure to different drivers, equities for growth, real assets for inflation sensitivity, hard money for currency stress, and your own skills and earning power. Even in an AI-driven world, adaptable skills still matter. Income flexibility is a form of diversification most people underestimate. Fourth, maintain enough liquidity to stay calm in downturns. This is non-negotiable. 6 to 12 months of living expenses gives you psychological and financial stability. Liquidity is not there to earn returns. It is there to prevent forced decisions. People who survive cycles are not the most aggressive. They are the ones who are not forced to sell when prices are down. Fifth, avoid leverage. Cheap money makes leverage look intelligent. In reality, leverage turns normal volatility into permanent damage. It removes your ability to wait. It forces action at the worst possible moment. History is brutally consistent on this point. Wealth transfers from the over-levered to the disciplined in every major reset. This checklist is not about getting rich fast. It is about staying solvent, flexible, and positioned while systems adjust. You do not need to predict what happens next. You just need to stop relying on strategies that only worked when debt was low and money was stable. That is how you stay ahead quietly, while others are still trying to understand why the rules changed. You do not need to predict what happens next. You just need to stop playing a game that no longer works. We are in fiscal dominance. The Fed is constrained by math, not politics. Inflation is the release valve, and the consequences are largely known, even if the timing is not. If this helped you understand what is really happening, like the video and subscribe so I can keep providing clarity while others argue headlines. I read all comments and emails personally, so do not hesitate to share what you are seeing or ask what you want broken down next. Preparation is quiet, panic is loud, and understanding the system early is how you stay ahead while others are still confused.